Hey traders, Raghee here, and in this free recap video we're going to be talking about gold, and not so much that the market's heading in our favor. I think a lot of the simpler futures folks know we're finally seeing the follow through in gold that we've been waiting on, but that's not really what I want this video to be about. What I want to talk about is this idea of where you want to enter. So let's jump into that right now. The idea here is there's always going to be a zone, and this is something we've been diving a lot more into lately. And you can see I kind of really emphasize the zone here. So whenever you have a trade that is a correction to continuation, correction to continuation. In other words, the market's heading lower, we get a bounce, and then we enter in that bounce and we're looking for lower lows, right? And this ultimately here is the zone. Now you'll notice I kind of broke this zone up into 3 sections. And the reason for that is to really emphasize where you get in is not a matter of right or wrong. It's a matter of risk tolerance. And there's no right or wrong in risk tolerance. Risk tolerance is a muscle. If on the first day in the gym, you can only curl 10 pounds, you can only curl 10 pounds. You know, and if you're a bodybuilder who's been doing this forever, you're curling small Volkswagens, right? But that's a muscle that's built over time. To expect on day one in the gym, you're going to curl as much as a 10-year, gym veteran is really, again, unrealistic. And you're going to rip your muscle clean off your arm, right? Oh my gosh, I've seen it. It's horrific. Well, what we want to do is remember that when there is an opportunity to sell into a rally, not every one of these zones is appropriate for every trader. The first zone is going to be what I'll consider to be the most aggressive. The second is less aggressive. The third is the least. The third is known as what I call on the mat for a long time, multi-year member, Matt. And Matt, if you're out there, we're thinking of you, buddy. We totally are. Our tribe is definitely a family, and Matt stepped away from the markets for a little while. We're thinking of you, and we can't wait to see you get back to the room. Miss you a bunch. So the thing to remember here about the 3 zones is the lowest zone, the one's red, is going to be the most aggressive. The least amount of reward, the most amount of risk. It's still a legitimate trade. It's still a trade that's valid. But it's not necessarily going to be a trade for everybody. Now, the only way you're going to know is if you have, of course, an exits first mentality. What do I mean by exits first? Exits first mindset. Exit first means, there we go. Exits first means that you are aware of how much risk there is at each and every level. Not how much reward, how much risk there is at each and every level. And then you decide whether or not you can handle the first, second, or third zone. Now, obviously, the more risk you have, the more of that zone is open to you. The less tolerance, the less. The least is this green little sliver up here. And when we've been designing trades lately, we've been talking more about this exit first mentality, the exit first mindset, and how each trade is a wide zone that is really divided by the middle line of the wave. Now, sometimes it's going to be the middle line of the wave. Sometimes it's going to be the middle of a range, right? You might have a middle of the range that we're traveling in. But there's always going to be a line that's going to differentiate the very aggressive to slightly more conservative. You've got to draw the line somewhere. And this is how we draw the line in a trend, right? So even though this trade started heading lower, if your risk tolerance wasn't suitable for, say, a 1209 entry, no problem. You went with 1216. If 1216 wasn't suitable, then you're looking at about 1222. If 1222 is still presented too much risk, you're up at about 1227.5. Now, this is not a missed trade if your zone is yellow or green. That's fine. Okay? Now, one of the things that we do, and I'll talk about this more in the premium video, is what are your alternatives if you're more of, say, a yellow or green zone type trader and not a red? What can you do at the red level if you want to trade it, you know what I'm going to say, either options or ETFs, because what you can do with an ETF is trade something like GLD, which a lot of our futures traders do. They go with the futures alternative ETF because now you can buy things per share. You can actually control your risk to a much smaller degree by maybe buying 200 shares of something, not a full contract. All right, the leverage is different, the risk is different. So you have a lot more flexibility with either going with the option or the ETF. And that's something I want to remind all futures traders. You know, I mean, we talk about stocks quite a bit because stocks make up a lot of these index and futures, and we talk about ETFs as alternatives. And that's something I want you to think about in the red zone. Okay, we'll talk more about that in the coming days and weeks. But think about the zone. You know, entries are not always singular levels. Get rid of that thinking of an entry being a singular level, and also start thinking about what risk is associated with each zone of your entry. And is that the right asset class, size, or even zone for you? Once you can start to do that, boy, the market really does change, and it's going to be something that you can have conform to what you want rather than you always conforming to it. All right, I'll see you in the next video.